European Central Bank's 1.1 trillion euros quantitative easing program is already having some strong impact on the region. But what does the ECB QE mean for private investors? To discuss this, I'm joined by Yves Bonzon, Chief Investment Officer at Pictet Wealth Management. Yves, thank you for joining me.
You're welcome. Good morning, Silvia.
So the ECB QE was definitely not a surprise to the market, was much anticipated, but perhaps a little bit delayed as well. What does it mean for private investors?
Well, essentially, QE can achieve two things. First of all, a portfolio rebalancing effect, whereby through the buying of financial assets, the central bank forces investors up the risk curves into more risky type of fixed income instrument, as well as equities and potentially real estate. So this has a stimulative effect on asset prices, which helps loosen monetary condition. Plus, it lowers the value of the currency, as investors have noticed. It has already substantially been discounted at the level where euro-dollar trades typically this morning. So that effect is in full swing, and it's potentially a significant one in Europe because unlike United States, where investors have a substantial portion of their financial assets invested in equities, European households tend to have a much lower share held in equities. So the potential for a shift away from negative yield instruments all the way up to more risky type of asset classes such as equities is very significant in Europe, even though risk premiums were already very compressed at the starting point of the European QE campaign.
So this could benefit the equity markets. Are you seeing some signs already of this happening?
Certainly. Look, in a place like Switzerland, where negative rates are prevailing all the way up to 10-year on Swiss government bonds, while unless it's not cheap, the Swiss market is offering a 3% dividend yield, there is a very strong temptation for investors to shift some of their capital away from fixed income instruments towards equities. The second effect that QE can potentially produce is stimulating domestic demand. We are unlikely to see that second leg of the policy impact in the European case, simply because to get this effect, you need fiscal policy to be stimulated. And that would mean accepting temporarily greater deficit by governments, ideally in changing also the spending mix away from transfer towards more spending in education, infrastructure, research, all sorts of projects that have a positive rate of returns over the medium to long term. Okay, so but that's not on the agenda, unfortunately.
No, so we introduced the subject of politics, which is, of course, essential when we look at Europe, particularly because there's been quite some political turmoil across the region, starting from Greece. Perhaps it would be appropriate to define it as such, and some new movements coming out of gaining momentum in Spain or even in Italy. What kind of surprises do you think we may get from Europe's political scene in the future?
Well, we are starting to see emerging side of the potential consequences because there's a perception in the markets that the newly elected Greek government has not obtained what it was looking for in the negotiation with Brussels. As a result of which, down in Spain, the polls have already shown recently a decline in the support for Podemos. So I think the Europeans are very aware that they should deal with the matter in a way that does not stimulate political currents in other countries that promote the end of austerity and basically reverse engineering all the structural reforms that very painfully have been implemented in the last few years. But that political risk remains, and should anything derail, you could see, we're going to have a test in France, we could see the emergence of extremist parties. So I think political risk is still out there and potentially derailing the whole process.
Thank you for your comments, Yves.
You're welcome.